The point is actually you have to ask a different questions. So the question is, if the revenue is growing, why would capital still discount it, right? And here are a few things that you have to consider. The first thing is test the revenue quality. So break the number down. So what is repeat revenue? One is one-off revenue. What is contracted revenue? What is founder-led revenue? As I mentioned, in this particular case where the relationship seems to be carrying for many years, and what will happen after the founder exits. So what I said, partner-led revenue, we mentioned the OEM and the white level situation. So what is delayed cash? If the board or the executive team or you as a founder cannot explain the quality of the revenue, the investment will assume the risk is higher than the management thinks. So test the revenue quality. The second thing is the assets location. Where are your assets? And these are many assets that you have to consider, like real estate, machinery, trucks, intellectual property, data, product designs, customer contracts. All these are license rights. All these are assets. So you need proof. Your distribution rights, your partnerships, all these are the assets of a company. This is what it makes your company valuable. So if these are split across unclear entities or weak documents, the asset story becomes harder to price. Then by default, your valuation starts to decrease. And the third thing to consider in this model is a partnership control, right? So ask whether each partner improve 5 things, actually, which is the access that you have, the margins, the customer quality, the reporting, and the compliance. These 5 things are very important when you are considering partnership, because if you have these 5 and you can explain them and you provide evidence, not that the partner only improve access, it may help the growth, but allowing with a stronger valuation rather than to weakening your position. As I mentioned, you might have the contract, you might have a steady order flow, but your collections start to be very volatile, meaning up and down, up and down. And this is weakening your valuation, it's not making you strong. Last question to consider. If the revenue, the assets, and the partnership cannot be explained cleanly, why should an investor give the company the benefits of the doubt? It doesn't happen because the capital or the investors or the shareholders, or when you are looking into the banks, they look into minimize the risk.